It is official. The United States government is changing how it taxes cryptocurrencies. In case you missed it, the $1.2 trillion infrastructure bill was passed in November of 2021. And one of the ways that the United States government has proposed actually paying for the contents of that bill is by adjusting how it taxes cryptocurrencies. And as we've seen in 2020 and in 2021, the cryptocurrency market is booming, meaning there is a ton of investors pouring money into this digital asset class. And this could also mean that Uncle Sam is about to get a huge payout. So today I want to talk all about cryptocurrency and taxes. Can the United States government tax cryptocurrencies? And what are these new tax proposals going to look like for the overall cryptocurrency market? But before we break all of this down, my name is Nate from Minority Mindset News, and if you like this video, make sure to smash that thumbs up button below and hit that notification bell too. That way YouTube shows our videos to way more money minds around the world, and we can keep making videos just like this one. Before we start talking about cryptocurrency and taxes and what these future taxes could be, you first have to understand where we have come from and what has led us to this point right now. The first thing you need to understand about this situation is the United States government will tax almost everything. Anything and everything that exists is taxed in some way by the US government. The US government taxes what you own, they tax what you sell, they tax where you live in, and they tax what you buy. And honestly, they tax a whole bunch of other stuff too, but if we went into every single thing that the United States government taxes, well, that would take up this entire video. So to keep things simple, the United States government taxes everything. And one of those major things that they tax is your investments. Now, why exactly does the United States government tax just about everything? Well, for one, the United States government has no other way to make money and pay its bills than to tax you. The United States government is a non-profit entity, meaning it doesn't make any money. So the United States government doesn't make any money, but it still does a lot of things. Like I said at the beginning of this video, the United States government just passed the $1.2 trillion infrastructure bill, meaning it needs to now have $1.2 trillion to fund this bill. Now, the United States government does not have $1.2 trillion just sitting around, so they need to print this money in order to fund the bill, at least right now. Retroactively, they're going to tax you in order to pay for this bill. And taxes can become a very tricky subject, but the bottom line here is this. The United States government taxes just about everything so that it can fund various programs. Essentially, when you pay taxes, that money is funneled into a variety of different things so that the United States government can then use it to pay for all of its programs. Now, how exactly does this affect cryptocurrency? Well, the United States government is proposing new tax laws on cryptocurrency investments. Now, taxing cryptocurrencies is nothing new. I mean, the United States government has been taxing cryptocurrencies for a very long time now. But they're going to change how the tax rules work in order to get additional revenue, so that way they can fund the infrastructure program. The way that it works right now is for a lot of other assets. Essentially, the United States government sees cryptocurrencies as a property. The reason being is because you own a very tiny piece of a much larger pie. There are a ton of cryptocurrencies out there. Bitcoin, for instance, if you own one Bitcoin, at maximum there's going to be 21 million Bitcoins available. So you own just one Bitcoin out of 21 million. That is your property and your stake in the Bitcoin game. Now, when it comes to assets and cryptocurrency, you do not pay any taxes when you buy the asset. You only pay taxes when you sell that asset. And the amount of taxes you pay is called a capital gains tax. So when you sell an asset, you're only going to pay money on the realized gains. So if you actually lost money on an asset, you won't actually have to pay taxes on it. This is because the asset didn't gain any value. But if your cryptocurrency or other asset starts to gain value, well, then you're going to have to pay money on that new value. But there is one key thing to note when we talk about capital gains taxes. So capital gains taxes only come into play if you hold on to that asset for more than a year. If you do this, then you'll ultimately be taxed less on the investment. However, if you hold on to the asset for less than a year, then you'll be taxed at whatever your income tax rate is. meaning you'll likely pay more in taxes. So if you hold on to an asset for longer than a year, you'll pay between 0, 15, and 20% taxes on that asset. So at the very least, you'll be able to keep around 80% of the total profits you made from that asset. And all of this currently applies to cryptocurrencies. But a lot of these tax laws that we have are based on the stock market and the real estate market, markets that have been around for hundreds of years. But the cryptocurrency market is very different, and it functions in a very different way than traditional investments. This is because it is so fresh and new to the investing world. For one, the cryptocurrency market is extremely volatile. One day, a cryptocurrency could be valued at $1,000, and the next, it could be valued at $0. This is how quickly things change in the cryptocurrency world. Now, what exactly does that mean? Well, it means there is a huge potential to make some serious money very quickly. On the flip side though, there is a huge potential to lose a lot of money. So this has led to a ton of different cryptocurrency investors investing in one coin and then selling it the very next day. They're able to make these quick profits even though they're going to have to pay a ton of taxes on that investment. What they're essentially doing here is trading cryptocurrencies. The same kind of thing happens in the stock market investing world. However, this can be very tricky for the IRS or the Internal Revenue Service when taxing cryptocurrencies, which brings us to the first of the major changes that the United States government is proposing when it comes to taxing cryptos. When you buy something online or you buy something with a credit or debit card, you're essentially giving that business access to your money. And you're also giving them access to your personal information. All of this information is tracked through their system, so that way they can report it all to the IRS. But buying something with a cryptocurrency is a little bit difficult to track. Essentially, when you buy a cryptocurrency, you can buy it in one of two ways. You can buy it on an exchange, or you can buy it directly from someone on a peer-to-peer network. You can then take this cryptocurrency and store it in an offline wallet, which is basically just an external hard drive, and then use it however you want to. Now, if you hold your money on a brokerage and keep your investment there, eventually when you sell, that brokerage is going to have to report that information to the IRS. However, if you have your money in an offline wallet and you get it from a peer-to-peer lending network, well, the IRS really doesn't have many ways to track that money. And this is what I've been saying about cryptocurrency and how tricky it is. We talk about other investments. If you want to get money from your other investments, say real estate, you will have to sell your real estate investment, which is called liquidating, in order to get cash. You can then take this cash and go spend it. All of this is tracked, and the United States government knows exactly how many bills are in circulation. You couldn't take your real estate property and bring it into a grocery store and try to buy groceries. No, you have to sell it first and then get cash. This is exactly the problem that they're running into with cryptocurrencies. You can now take direct Bitcoins and go buy something, but you're essentially taking your property and using it to buy things with. Now, if people took their Bitcoins and sold them for US dollars, then we wouldn't really have a problem here. But because you can take Bitcoins and then use them to buy things, well, that becomes a bit difficult to track with the IRS. So this new provision will actually expand US tax code 60501. It will now include digital assets. So now, anytime you use a Bitcoin or other cryptocurrency to buy something, that information is going to have to be reported to the IRS. Your personal information, like your name, address, and social security number, is all going to the IRS. However, this reporting is only going to have to be done on transactions that exceed $10,000. So the business takes your information and then reports all of that to the IRS. This will show the IRS who you are and how you actually made that purchase. The reason for this is because they want to know where the money is coming from. They want to make sure that everything is in line and that you didn't get this Bitcoin illegally. The IRS wants to make sure that everything is tracked so that all of the dollars in our society are fully tracked. They're hoping this one provision will cut down on crimes and some other illegal activity that sometimes occurs in the cryptocurrency space. And the other provision the United States government is making in order to tax cryptocurrencies more is looking at cryptocurrency brokers. A brokerage is a place where you can buy and sell an asset. So we have tons of brokerages for the stock market. It's basically your connection to the stock market, and you can use it anywhere in the world. This allows you to buy, sell, and hold your assets all through the brokerage, and it makes the process very easy and very convenient. However, cryptocurrency brokerages like Coinbase will now have to report cryptocurrency gains on a 1099 type form, and they will have to disclose all of the information of their customers. This includes names and addresses. Now, the US government has already stated that this will not include miners and any hardware developers. It will only include brokerages. So essentially, this gives the IRS more oversight into who's buying and selling cryptocurrencies within brokerages. Now, there is one major problem with this, and again, it's because of offline wallets, these external hard drives that cryptocurrency owners have. If you own a cryptocurrency on a brokerage and you decide to sell, well, you're going to have to pay some sort of taxes on those gains. However, if you hold your cryptocurrency on an offline wallet and you decide to sell it to somebody offline, well, how is the IRS going to know about that? In addition, the brokerages will have no idea how much you initially paid for that investment if you hold a lot of your cryptocurrency on an offline wallet. Part of capital gains is paying taxes on those realized gains. This means the brokerage knows exactly how much you paid and exactly how much you sold that asset for, and then you're taxed accordingly. However, if you have $100,000 worth of Bitcoin in an offline wallet, and then you send all of those Bitcoins to yourself on, say, a Coinbase exchange, and then make a sale, well, Coinbase is going to have to report that you sold $100,000 worth of Bitcoin. This is where things are going to get a bit tricky because Coinbase or other brokerages are basically just going to have to guess how much you actually paid for that asset. This could lead to overstating your capital gains. And right now, the US government doesn't really have much of a solution. They basically say that it's up to the investor in order to figure this all out. The way I see it, this could lead to one of two things. One, it could lead to overtaxing people for their cryptocurrency investments, and two, it could lead to severely undertaxing people as well, because there's no real way to find out exactly how much you owe in taxes. So what exactly does this all mean? Well, it means that the United States government and the IRS are taking a large step in trying to figure out where all of this cryptocurrency money is coming from. The IRS is trying to get better and more accurate reporting so that way they can tax investors accordingly. So technically speaking, the United States government hasn't released any actual plans to tax cryptocurrencies more than they already are. But they are hoping that these new provisions will help make reporting a lot more transparent. However, these two new provisions directly affect cryptocurrency investors. For one, there is a lot of privacy at stake here, and that is one of the biggest reasons why people love to invest in cryptocurrencies. All cryptocurrency transactions are recorded on a blockchain. However, it is completely anonymous who is buying and using these cryptos. This is part of the decentralized nature of cryptocurrencies. However, it looks like that is going to change because now businesses are going to be required to report information to the IRS about who is making this purchase with cryptocurrencies. And number two, buying and selling cryptocurrency might get a bit more complicated. Brokerages are going to have to start reporting a lot more information to the IRS, and one of the reports that they're going to have to send is how much you bought and sold on their platform. So if they don't really know, they're going to have to guess because they're legally required to send the IRS something. This means that the way you're taxed on your cryptocurrency gains may get a bit more complicated too. And the IRS is basically saying that you need to work with them in order to figure this all out. Now, these are the current provisions as they stand. And it's important to note that none of these provisions are set to take effect until 2024. And as we know, when it comes to the business and financial world, a lot can change in just a short period of time. So who knows if these provisions are actually going to come through within the next few years. Right now, it looks like the Treasury Department is researching these provisions and trying to figure out how they would actually work within the real world. And this process could take years. And ultimately, it will be up to the Treasury Department to say exactly how these new provisions will affect cryptocurrency investors and who they will actually affect in general. On the flip side though, cryptocurrency lobbyists are already advocating that these provisions be completely deleted. And they're already pushing for amendments to this infrastructure program that tax cryptocurrencies in this way, or standalone bills that will ultimately change how these provisions are enacted within our real world. So nothing about these tax implications are official as of yet. But what is official is it looks like the United States government is taking the very first step in trying to regulate cryptocurrencies in America. So that could lead to some major shakeups and changes in the cryptocurrency space. But just remember this, Uncle Sam will always get his cut. Taxes are always going to be around and you can't really avoid them. So it's not totally crazy to think that cryptocurrencies could be next on Uncle Sam's list. But now I want to hear from you on this issue. Do you think that businesses and brokerages should have to report all of this information from cryptocurrencies users to the United States government? Or is all of this reporting completely unconstitutional and the United States government has no right to request this information? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you like this video, make sure to hit that subscribe button below. Keep hustling, money minds, and I'll see you all in the next one.